Good day everyone. In this video, we have Mr. Sachin Shah, Fund Manager, Emkay Investment Managers. Hello sir. It's been nearly 4 to 5 years since the launch of Emkay Emerging Stars Fund Series 1, 2 and 3. You are now in the process of distributing the capital and returns back to the investors. So I think my question is, how has the journey been so far?
Sure. So, the last 4 to 5 years, if I have to say that it has been a roller coaster ride, I think it will be an understatement, right? From that perspective, one does tend to get a bit nostalgic of this entire journey. We actually launched this fund in calendar year 2018, January 2018, and this is a small cap focused fund. And if one will go back and see the data points, calendar year 2018 was a year when we had a serious meltdown with the valuations, particularly in the mid caps and the small cap. If I remember, from January 2018 till March 2019, in that 15-month period, the small cap index was down 25%, right? So valuations kind of corrected quite well when we entered calendar year 2019. But as soon as we thought that the prices were good, the challenges started erupting on the domestic economy front, right? We saw a lot of headwinds out there, and calendar year 2019 we saw a serious slowdown when it came to the domestic growth. We saw that playing out the entire calendar year, and then when we entered calendar year 20, early January, February, I distinctly remember we started seeing some decent amount of green shoots. Because if you go back to say in the history, sometime in the mid of 2019, the government started coming out with big bang reforms to revive the economy. In fact, they kind of they reduced the income tax rate from the maximum from 33% to 25% for new manufacturing capacities to come at 15%. And like this, there were quite a few more reforms. So clearly, we could see some green shoots happening in the early 2020. But we know what happened in March 2020, and that was like literally earth-shattering, because COVID as a virus was probably not something that really worried us. But I think the lockdown, that's absolutely unprecedented, right? The world coming to a standstill, and not for one day, 1 week, but like for a longer period of time. And that was something that really is very, very strong in the memory even now, right? But as they say, all is well that ends well. So over this 5 years, 4.5, 5 years, I think the good part is that today we have delivered almost 1.9x. Our portfolio values are today 1.9x as on 30th September, which the XIRR is about maybe in the range of 17-18%. And of course, we've also outperformed the benchmark. So like the benchmark small cap indices would be at least 500 bips lower over this period, right? The other good part about it is that we've been able to actually return the capital to the investors along with the profits, right? So at this point in time, we've already returned 115 to 120% of their invested capital, and we are well on the path where we'll be returning the entire fund money before the end of this calendar year, right? So in that sense, it's been a very, very interesting journey and a lot of learning, I would say. If I have to really think about it, and what really played out during this 4.5, 5 years, right? What are the key learnings? To my mind, there are two important things which has actually played out brilliantly. And that has been a razor sharp focus on quality and discipline. And when I say quality, we are talking about quality of management and quality of business. So, we've spoken about our proprietary module Equal, where we are extremely focused about the management integrity, management capability, wealth distribution to minority shareholders, investor communication, liquidity, and so on and so forth. And this is a very objectively defined proprietary module, and that has really steadied us very, very well all these 5 years, because 2018, 2019, I remember at least probably 100 odd companies which had serious corporate governance challenges. Very, very happy to say this, that in this 5 years, or not only this 5 years, over this last 10 years that we've been implementing this equal model, we've not had even one challenge when it came to our portfolio holdings where there has been any challenge on corporate governance. So, focus on quality has really helped us maneuver during this difficult periods. We've navigated it, and today the returns are there for the investors. So that's definitely a happy feeling. Also discipline, right? Discipline in terms of your allocation discipline, right? So we are very, very clear that we want to have focused portfolios, but also avoid any kind of concentration risk, right? And not only at the time of investing, but also there will be periods when a few particular your portfolio holdings will actually rise much higher because they are outperforming the overall portfolio. So even at that point in time, it is important that you at least cut the tail. I'm not saying that if it just goes up by 200 bips, but if a particular stock has gone beyond 15-20% of your full portfolio, it is important that you at least cut the tail, even if you're very positive about it. Yes, it might mean that you're losing, you're giving away some profits, leaving on the table, but still discipline plays a very important role. And discipline not only during investing but also during divesting. So like for example, we know that 23 is a year when our funds come to maturity, but we started planning very gradually to exit during the calendar year 22 itself. And every 3 months, every quarterly, we've been gradually returning the capital to the investors, and of course now the returns also. So I think quality and discipline, quality of business also, right? So when we talk about quality of business, focus on cash flows, on the operating cash flows, on the balance sheet discipline that the management has, because every business goes through a good and a bad cycle. And how did the management actually maneuver during the bad cycle gets reflected in the balance sheet, since it's a cumulative of all these years. The capital allocation, how disciplined they were when it came to debt, how disciplined when came to forex debt, did they take hedged forex debt or unhedged forex debt. All of this actually starts playing out during the difficult times. And so our portfolio holding companies have really studied well all these 5 years, and that has been the biggest satisfaction to my mind. So I think our investors are also quite happy with we're delivering 17-18% XIRR over this 4.5-5 years, and where we have also outperformed the benchmarks.
Well, that's really good to hear. And if I were just kind of move forward in terms of what's next for you, I believe that you've just recently launched Emkay Emerging Stars Fund Series 5, which is a multi-cap manufactured focused fund. So I kind of wanted to understand from you why you're so upbeat regarding the manufacturing space.
Sure. So, manufacturing is something what actually has been doing well for quite a few years. But in the last 5 years, manufacturing sector had a lot of headwinds. It started with GST. It started with demonetization. Then it was GST, and then of course COVID. So every time it was kind of trying to come back, something or the other kind of suppressed it. But the good part is that during these 5 years, the sector as a whole, when we see the balance sheets, when we see the profitability, the inherent profitability of the businesses has improved significantly, right? So the companies have really focused on their deleveraging of the balance sheets. They focused on their working capital. When COVID happened, most of the companies got very, very cost efficient, assuming that there will be very, very muted top line, whereas actually the top line has been far better. The aggregate demand has been far better than anybody anticipated. So today the cash flows are far more stronger because you have a very, very strong top line, and your cost structures are very, very lean, which is really helping, and plus the balance sheet is allowing the cash flows to get generated in a big way, right? So this is something what is really playing out today in the manufacturing sector when we look at the aggregate data, right? That's one part of it. The other part of it is that we are also seeing a lot of catalysts, right? And when I say catalysts, it's coming from the domestic side and it's also coming from the global side. Domestic side, clearly the government is really, really focused in reviving the manufacturing sector in a big way, not only reviving but also seizing some of the global opportunities that today is offered to a country like India. And from that perspective, the government of India is actually really helping the sector, right? Like, we saw the PLI scheme, right? And when we talk to the corporates, I mean, most of the corporates are really saying that this time we believe the government is genuinely wanting us to, deliver very strongly, and they are really listening to us if there are some challenges with the particular scheme or anything of that sort. In fact, as I mentioned earlier, I think the reforms or the focus of the government on the manufacturing sector started even pre-COVID in 2019, when they reduced the tax rates from 33% to 25%, the income tax rates, and even for the new manufacturing units to 15%. That clearly shows that directionally the government is focused on basically reviving the manufacturing sector in a big way, right? So and on the globally, what has happened is that because of geopolitical challenges, particularly post COVID, the alternate supply chains the world is looking at, and of course India is just going to be one of them, and we will have to prove ourselves to seize that opportunity. But there are at least few industries, right? Whether it is auto and auto ancillaries, chemicals and pharmaceuticals, engineering, even now probably electronics manufacturing, textiles. These are few industries where India has already proven its expertise, the domain expertise. It has already proven that they can deliver scale, and in certain businesses like in the pharmaceutical businesses, the CRAMS business, where there are also requirements of IPR, the intellectual property rights preservation. So there also I think we have gained the confidence of the global customers or the big global companies. This is one place where they can actually trust. So, all of these catalysts are really coming into play, which is really making us believe that manufacturing sector is at an inflection point, because all this has played out. And if I see, if I just take the period of say 2017 to 2022, manufacturing sector has kind of underperformed the Nifty, right? But previous 10 years, manufacturing sector has been outperforming the Nifty. So probably now it's going to be catching up with the mean, along with the earnings growth far more accelerating than what we have seen in the last 5-6 years, because the foundation has been laid, right? And the headwinds have now turned into tailwinds, which is really going to give a big impetus to this sector, is what we believe. And that's why we have come up with this fund, Emkay Emerging Stars Fund Series 5. It's a multi-cap portfolio focused on manufacturing sector. Also if you think about it today, most of the investor portfolios are very highly loaded with two particular sectors, which is BFSI and IT. Simply because most of the large indices have nearly 50 to 60% weight coming from these two sectors. So in that sense, investors are underweight on the sector where we believe there is going to be a very large inflection point, and that's why we believe that the next 5 years there is a high probability of we outperforming with this particular fund.
Thank you so much, sir, for sharing your investment journey and the insights and learnings that you've had through this period. And thank you so much for giving us the time to have this session.
Sure, thank you. Always a pleasure.